Something just shifted inside America's financial system, and almost no one is talking about it. A signature, one signature, placed quietly on a federal order, while the country was watching something else entirely. But that signature may have just changed where trillions of dollars are allowed to go next. Not stocks, not bonds, something else. Something investors have trusted for over 5,000 years. And by the time most people understand what just happened, the window may already be closing. Stay with us, because what you're about to learn could change how you think about your own money. Welcome back to Precious Metals Intelligence, the channel built for people who prefer to understand the system before the headlines catch up to it. If you're new here, this channel exists for one reason: to translate complex monetary policy into something clear, honest, and useful for people who've spent decades building what they have and have no interest in gambling it away on hype. Before we go further, we'd love to know, where are you watching from today? Take a moment, drop it in the comments. This community spans more places than we can count, and it means a great deal to see just how far this conversation reaches. For almost 100 years, there has been an invisible wall inside the American retirement system. Most people never noticed it. They never had a reason to. Every payday, a portion of their paycheck moved into a 401k account, and from there, it went into one of two places: stocks or bonds. That was the rule, unwritten but firmly enforced through decades of legal caution. Gold was not an option. Silver was not an option. Real assets of almost any kind were kept outside the gate. That wall did not fall because of a market crash. It did not fall because of a stock market panic or a banking crisis. It fell quietly, through a single signature, placed on a federal order that most news channels barely mentioned. In August of 2025, an executive order was signed with a long technical title. Something about democratizing access to alternative assets for retirement investors. It sounded bureaucratic, it sounded boring, and that is exactly why almost nobody paid attention to it. But underneath that dry title was a decision that could reshape how trillions of dollars move for years to come. To understand why this mattered, it helps to understand who actually controls what goes inside a 401k plan. It is not the individual saver. It is a person called a fiduciary, someone legally responsible for choosing which investment options appear on a retirement plan's menu. For decades, these fiduciaries operated under a simple fear. If they added anything unusual to a retirement plan, and that investment performed poorly, they could be sued. So the safest choice, the choice that protected them personally, was to keep the menu narrow. Stocks, bonds, nothing else. This was not a suggestion. It was not a talking point for a campaign speech. It was a formal instruction, moving through the actual machinery of federal regulation. In the months that followed, the Department of Labor began issuing advisory opinions that supported this new direction. Step by step, the process moved forward, the way government processes usually do. Not quickly, not dramatically, but steadily. By early 2026, that process had advanced far enough that select 401k plans could begin adding physical, IRS-approved gold and silver as an option for savers. This is not a rumor circulating on social media. It is documented, published federal policy, still unfolding in real time as new plans adopt the change. Now, here's the detail most coverage missed entirely, and it is the detail that matters most to anyone paying attention to their own financial future. This is not a small technical adjustment buried in a government filing. It is the opening of a door that has been sealed for almost a century. And it is a door standing between everyday savers and an asset class that behaves completely differently from stocks and bonds. An asset class with no dependence on corporate earnings, no dependence on a company's quarterly report, no dependence on investor sentiment swinging up or down. Consider the scale involved. Roughly $12.5 trillion sits inside 401k accounts across the United States today. That is not a number attached to a single company or a single sector. It is the retirement savings of tens of millions of working people built slowly over entire careers. Even a small percentage of that capital shifting toward physical gold and silver would represent a meaningful new source of demand, one that did not exist in this form before. This is why the order deserves far more attention than it received when it was first signed. It did not happen during a moment of crisis. It happened quietly, methodically, through the normal channels of federal rulemaking. But the effect, once fully understood, is anything but quiet. A wall that stood for nearly 100 years has come down, and the implications of that shift are only just beginning to unfold. In the next part, the focus turns to a question that matters just as much as the order itself. Why is this happening now, at this exact moment in the economic cycle? The answer involves debt, inflation, and a Federal Reserve facing a level of uncertainty it has not faced in years. Timing matters. In economics, almost nothing important happens by accident, and this shift in retirement policy is no exception. To understand why the doors to gold and silver opened at this particular moment, it helps to step back and look at the wider financial picture the United States finds itself in today. Start with debt. For decades, the federal government has spent more money than it collects in taxes. This is not new. Governments around the world do this regularly. But the scale of American debt changed sharply after 2020. Trillions of dollars went out during emergency spending. More trillions followed for infrastructure projects and industrial programs. And on top of all of that, spending sits something quieter, but just as important: interest payments on a debt pile that keeps growing larger every year. When a government owes far more than its economy can realistically grow its way out of, there are only three real paths forward. The first is to raise taxes and cut spending sharply enough to close the gap. This is politically painful, and history shows it rarely gets carried through completely. The second path is default, simply failing to pay what is owed. For a country that issues the world's reserve currency, this option is almost unthinkable. It would shake trust in the financial system worldwide. That leaves the third path, the one governments have chosen again and again throughout history, quietly letting the currency lose value over time. This does not require a dramatic announcement. There is no press conference where a leader admits this is happening. Instead, it shows up slowly in rising grocery bills, in home prices climbing faster than wages, and eventually in the price of the metals that have served as trusted stores of value for thousands of years. Economists have a term for this slow erosion: financial repression. Some simply call it currency debasement. This brings the story to the Federal Reserve and to its newest chair, who took the position in May of 2026 after his predecessor's term came to an end. He inherited an economy where inflation refused to cooperate. By that point, consumer prices were rising at roughly 4.2% per year, more than double the Federal Reserve's stated target of 2%. And the central bank's own preferred measure of inflation was running even hotter than that. Rather than continuing the detailed forward guidance markets had grown used to, the new chair chose a different approach. He described it as purely data-dependent, meaning the central bank would react to incoming numbers rather than promise a fixed plan in advance. In practice, this has meant interest rates held steady in a narrow range, month after month, while policymakers themselves remain openly divided. Roughly half lean toward eventually cutting rates. The other half warn that rates may need to rise further before inflation is truly under control. That kind of visible disagreement at the very top of the most powerful central bank in the world is not a small detail. It sends a signal to markets that even the people with access to the best data and the most advanced economic models are not confident about what comes next. An uncertainty of this kind has historically pushed investors toward assets that do not depend on any single institution's promise. Assets that exist outside the banking system entirely. This is precisely where gold and silver return to the conversation. Not as speculative bets, but as what they have always been throughout history. Monetary assets with no counterparty risk. Assets that cannot simply be created at will the way currency can be printed or debt can be issued. Gold has played this role for thousands of years. Silver carries a similar reputation, though its story includes an additional layer that makes it worth examining closely on its own. None of this happened in isolation. The retirement policy shift discussed earlier did not arrive during a calm, stable economic period. It arrived in the middle of rising debt, a divided central bank, and inflation running well above target. Understanding that timing is essential because it explains why this policy change is not simply a bureaucratic footnote. It is unfolding at precisely the moment when interest in alternative stores of value is already rising for entirely separate reasons. In the next part, the focus shifts specifically to silver. Why this particular metal, more than almost any other asset, sits at the center of a story involving industrial demand, shrinking supply, and a role in the global economy that most casual observers overlook entirely. Not every metal tells the same story, and silver's story is unusual in a way that deserves careful attention. Unlike gold, which serves almost entirely as a store of value, silver leads something of a double life. It is both a monetary asset and an industrial material, and that dual identity shapes almost everything about how its price behaves. Roughly half of global silver demand comes from industry. Solar panel manufacturing relies heavily on silver because it conducts electricity better than any other metal on Earth. Electronics depend on it. Medical equipment depends on it. As the world continues building out solar infrastructure and expanding electronic manufacturing, that industrial appetite for silver keeps growing, regardless of what happens in financial markets. The other half of demand comes from investors, people and institutions, buying coins, bars, and now, increasingly, retirement accounts. This is what makes silver different from almost any other commodity. It responds to two very different forces at the same time. Fear, the same fear that pushes people toward gold during uncertain times. And genuine industrial growth, tied to real-world manufacturing, needs that have nothing to do with financial anxiety at all. When both of these forces move in the same direction together, the price can shift dramatically, far more sharply than gold typically does. Now add a supply problem sitting quietly underneath all of this. As of 2026, the world is entering its sixth consecutive year in which silver mine production has failed to keep up with total demand. This is not a small technical detail. It is a structural imbalance that has been building for years, largely unnoticed by mainstream financial coverage. Here is what makes this especially difficult to fix. Silver is rarely mined for its own sake. Most of the world's silver supply comes as a byproduct of mining other metals entirely, particularly copper, gold, lead, and zinc. This means silver supply does not simply expand when silver prices rise, the way supply normally responds in a functioning market. Mining companies are not digging new silver mines because silver became more valuable. They are digging copper mines and gold mines for entirely separate reasons, and silver simply comes along for the ride, whether the world needs more of it or not. 6 straight years of demand outpacing supply has slowly worked down above-ground silver inventories that took decades to build up. This is not a minor footnote buried in a mining report. It is a slow-moving supply squeeze that has been tightening steadily while most financial media focused its attention elsewhere. Layer geopolitics on top of this picture. Tensions in the Middle East, including disruptions tied to shipping routes through the Red Sea and the wider Gulf region, have periodically pushed oil prices sharply higher throughout 2026. Rising energy costs feed directly back into the inflation numbers the Federal Reserve watches so closely, adding yet another layer of pressure to an already complicated economic picture. Meanwhile, a separate and equally important trend has been unfolding at the institutional level. Central banks around the world, not hedge funds, not individual traders, but actual national monetary authorities, have been accumulating gold at a pace not seen in modern record-keeping. Much of this is tied to a broader effort by countries seeking to reduce their reliance on the US dollar as the sole foundation of their foreign currency reserves. Economists refer to this trend as de-dollarization. Whatever one's view of the politics behind it, the practical effect on precious metals demand is straightforward. When institutions holding trillions of dollars, numbers on a screen rarely teach anyone anything until they are seen through the lens of an actual decision, made by an actual person, under real financial pressure. To understand how this shift in policy might play out, it helps to imagine 2 very different approaches, both plausible, both common among everyday savers navigating this new landscape. Consider a mechanical engineer in his mid-40s, living outside a major city, someone who spent his entire adult life following standard financial advice. Max out the 401k, put it into a low-cost index fund, do not touch it, let time and compounding do the work. This is sound advice, and nothing in this story suggests otherwise. But after watching his account swing sharply during a stretch of market volatility, he began reading about the retirement policy changes opening the door to precious metals. He did not panic. He did not empty his account into silver coins overnight. Instead, after months of quiet research, he redirected a modest portion of his new contributions, somewhere around 8%, into a plan option that included physical metal exposure once his employer added it. His reasoning was simple. He had never owned anything inside his retirement account that did not depend entirely on corporate earnings and investor mood. He wanted one asset that behaved differently when everything else struggled. Now consider a very different path. A woman in her early 30s, working in marketing, with almost no prior investing experience. She first learned about silver through a video with an alarming thumbnail, promising explosive gains, and a retirement system suddenly unlocked. Within a week, driven more by fear of missing out than any real understanding of what she was buying, she moved a significant portion of her modest savings into silver near a short-term price peak. She had no plan for what she would do if the price dropped. When silver pulled back several percent shortly afterward, ordinary behavior for a historically volatile metal, she panicked. She sold near the bottom of that dip, locking in a loss that was never necessary in the first place. Her mistake was not that silver was a poor asset. Her mistake was entering a volatile market with no plan, no understanding of normal price swings, and no emotional preparation for the discomfort that comes with holding an asset the market has not fully priced yet. These 2 outcomes are not simply about luck or timing. They reflect something deeper, rooted in basic human biology. When markets move sharply, whether rising or falling, the brain does not process that information calmly. A part of the brain called the amygdala, responsible for detecting threats, reacts to both fear and excitement, and it reacts faster than the more rational part of the brain can catch up. This is not a character flaw. It is simply how the brain is built, wired for a world where quick reactions once meant survival. But a price pullback in a carefully researched asset is not a predator in the grass. It does not require instant action. Yet the brain does not know the difference, and it floods the body with stress signals regardless of whether real danger exists. The same wiring works in reverse as well, and in some ways it is more dangerous because it does not feel dangerous while it is happening. When an asset rises quickly and others appear to be profiting effortlessly, the brain releases signals of anticipated reward, creating a powerful urge to act immediately without a plan. This is precisely why professional investors emphasize deciding an approach in advance, long before emotion enters the picture. Position sizes, entry points, and overall strategy should be settled in a calm state of mind, so that when volatility arrives, as it inevitably does, there's already a plan to follow rather than a decision to make under pressure.